I'm frankly delighted that the economy has held together as well as it has in the face of higher interest rates. I didn't think that the Fed would have the ability to tighten as fast as they did. My suspicion is that the pain will continue to be felt on a more delayed basis. I think the halting sales of things like consumer durables, but more importantly, single-family residential, and certainly the malaise that you're seeing in equity markets, means that there's more pain to come. But I'm frankly delighted that they've been able to get away with as many raises as they have, if only so that they, from their point of view, have some powder dry, the ability to loosen if they think they need to. I lived through a period where the prime interest rate exceeded 15%, where the first mortgage rate exceeded 17%. And believe me, it can get worse than this. The pain coming out of the inflation of the 1970s, the Volcker-induced pain, while it was necessary, was severe. The misery index, as they called it in those days, which was the sum of the U.S. 10-year Treasury rate and the rate of inflation and unemployment, was spectacular. So as painful as this has been for some, it is only a down payment on the pain that we might have expected had they totally lost control. I realize that's a small measure of relief for people who are suffering pain this time, with the caveat that I'm not an economist. You could stabilize inflation other ways. You could have less government control. You could have less government expenditure. An awful lot of the inflation that we're experiencing was in fact caused by government. The way that the government created liquidity for an economy that they were crowding out by public borrowing was in fact artificially low interest rates. I don't believe that the current political situation in the United States would allow the Fed to reduce inflation by the way that Mr. Forbes suggests. I wish it were the case, but the truth is, if you were, I suspect, to poll Republicans and then poll Democrats as to whether they would see their favorite government programs, if they'd be willing to see their favorite government programs defunded in order to put the economy on a better footing, most would say no. So while what Mr. Forbes says is possible in the theoretical world, I think it's improbable in a world where voters continue to attempt to award themselves favors. You must either have fiscal controls or monetary controls. I said that while cash imposes immediate pain, in the sense that the deposit interest rates that you get paid guarantee you a loss after inflation, you have to have cash anyway, because in a period of declining liquidity, particularly if we have a replay of 2008, the cash will give you the tools and perhaps the courage to take advantage of a situation rather than being taken advantage of. It is true that you are, after inflation, losing 4 or 5% of your purchasing power holding cash. But I have two observations. That negative interest rate that you suffer is really an option premium to allow you the liquidity to take advantage of the illiquidity of others. And as we have seen in 2022, losing 5% beats the hell out of losing 20% in other asset classes. So I continue to say that investors, despite the pain, must continue to be liquid. For me personally, that liquidity includes gold. I include it because I am willing to sell my gold, use it as liquidity, if a different asset class becomes more attractive to me. Many investors, if they bought gold at 1,800, are unwilling to sell it at 1,650, even if there is a more suitable opportunity on the horizon, because they don't want to quite, quote, take a loss. For me personally, liquidity comes in many forms, principally US dollar liquidity, but also liquidity by way of bullion. This doesn't feel dramatic to me. People are angry, people are hurt, people are confused. People are not terrified. I remember 2008 very, very, very well. I remember that members of the public, not just the chattering classes, were concerned about the total breakdown of financial markets in the United States. People were worried about bail-ins. They were worried about their savings being confiscated by the Fed to salvage the banking system. I don't see that level of fear yet. In 2008, we watched major markets go no bid. Right now, we're just seeing markets go lower. I'm not trying to say that we are going into a period of full-blown panic. What I am trying to say is that investors need to be defensive, both with regards to their portfolios, but probably particularly with regards to their psyches. You are going to continue to experience lots of volatility. And if you have a strong psychological framework in your investments, you are more often than not able to take advantage of volatility as opposed to being taken advantage of by markets. Someone described the US dollar as, quote, the prettiest mare at the slaughterhouse. The circumstance around the US dollar in the intermediate term and the long term is not pretty. However, the crisis in other currencies, particularly, of course, the euro, with the political instability in the southern cone of Europe, but also in Great Britain as a consequence of some of the political decisions made there over the last 10 years, means that they are facing their reckoning before we are. And the instability there, and particularly the very, very low real and nominal interest rates there, mean that European savers have a real incentive to dump euros, dump pounds, and buy dollars. And that's precisely what you're seeing. I sleep better owning gold. And at 69, sleep is an important thing. I hope, Daniela, I'm wrong about gold. Gold does well during times when people are concerned about the stability of their purchasing power in ordinary currencies in a normal economy. And I hope I'm wrong. I hope I'm wrong to be concerned. However, I need to say, personally, I'm suited by lower gold prices in the near term. If gold were to advance from 1,650 or whatever it is an ounce to 22 or 2,300, I wouldn't sell. It would evoke no action from me. If gold were to fall from $1,650 to $1,500, I would buy lots. So, ironically, although I have reasonable gold holdings, it is in my interest, given the way I would like to organize my own affairs, to see the gold price lower rather than higher. Now, that will evoke a lot of hate in the comment section. People will say he's old and fat and rich. All of that is true. I suspect that if other people adopted the time frames that would allow them to become rich, that they would become rich too.